They told us the system was safe. They told us the smartest people in the room had figured out how to eliminate risk from the financial system. They said you could take the most dangerous bets on earth, wrap them in mathematics, and make them disappear. For years, Wall Street believed it. The regulators believed it. The rating agencies stamped it with a AAA seal and collected their fees. At the center of all of it, quietly writing checks it could never cash, was one company, not a hedge fund, not a rogue bank. An insurance company from the streets of Lower Manhattan, AIG. American International Group. Inside AIG, buried deep in a satellite office in London, was a division so small, most people at the company had never heard of it. It was called AIG Financial Products, and it nearly ended the global economy. To understand how one division of one insurance company almost brought down civilization, you have to go back to the late 1980s. AIG was already a giant by then. It was the largest insurance company in the world, a sprawling empire built by a man named Hank Greenberg over the course of 4 decades. Greenberg ran AIG like a personal fiefdom. He was aggressive, secretive, and obsessed with growth. Under his leadership, AIG expanded into nearly every country on Earth, insuring everything from oil rigs to cargo ships to Hollywood movies. The company's balance sheet was massive, its credit rating was pristine, and its reputation was rock solid. That reputation became a weapon. In 1987, a group of former Drexel Burnham Lambert traders approached AIG with an idea. Their leader was a man named Howard Sosin, a mathematician who believed he could use complex financial models to generate enormous profits with virtually no risk. Greenberg gave them a home. AIG Financial Products was born, operating out of a small office on Curzon Street in London, far from headquarters, far from oversight, and far from anyone who could have understood what they were actually doing. For the first decade, the division printed money. It traded interest rate swaps and other derivatives, earning hundreds of millions a year. The profits flowed back to the parent company, and nobody asked too many questions. Sosin eventually left after a dispute with Greenberg over compensation, and a man named Tom Savage took over briefly before handing the reins to Joe Cassano in 1998. This is where the story turns dark. Cassano was not a mathematician. He was not a trader in the traditional sense. He was an accountant by training, a man described by colleagues as intensely controlling and allergic to dissent. Under Cassano, AIG Financial Products found a new goldmine: credit default swaps. A credit default swap is essentially an insurance contract on a bond. If the bond defaults, the seller of the swap pays out. If it does not default, the seller keeps the premium. It is a simple concept with a terrifying twist. Unlike regular insurance, you did not need to own the bond to buy a swap on it. And unlike regular insurance, there were no reserve requirements, no capital set aside in case you actually had to pay. AIG Financial Products started selling credit default swaps on mortgage-backed securities, those bundles of home loans that Wall Street had been packaging and selling to investors around the world. The logic was seductive. American housing prices had never declined nationally, not once in modern history. So insuring against mortgage defaults looked like free money. You collect the premiums, the mortgages keep paying, and you never have to write the check. By the mid-2000s, AIG Financial Products had written over $500 billion in credit default swap exposure, $500 billion from a single office with a few hundred employees. And here is the part that should keep you awake at night. None of it was hedged. They had no insurance on their insurance, no offsetting positions, no rainy day fund. They were simply betting with the full faith and credit of the world's largest insurance company behind them that American homeowners would keep making their mortgage payments forever. The model said the risk was negligible. The quants had run the numbers and concluded that the probability of a nationwide housing decline was so remote it was not worth planning for. Cassano himself reportedly told investors in August 2007 that it was hard to see any scenario where AIG Financial Products would lose even a single dollar. The housing market was already cracking. Subprime delinquencies were climbing. Foreclosures were accelerating in Florida, Nevada, California, and Arizona. But the models did not account for what was actually happening on the ground because the models were built on historical data that had never included what was about to happen. When the housing market did collapse, the calls came in all at once. AIG's counterparties, the banks and institutions on the other side of those swaps, started demanding payment, and not just payment on defaults. The contracts included collateral calls, meaning that as the value of the underlying mortgages declined, AIG had to post billions in cash just to maintain the positions, cash it did not have. In September of 2008, the cascading collateral calls pushed AIG to the edge of bankruptcy in a matter of days. And this is where it stops being a story about one company and becomes a story about the entire world. AIG's counterparties were not small players. They were Goldman Sachs, they were Deutsche Bank, they were Societe Generale and Barclays and Merrill Lynch. If AIG defaulted on its swap obligations, every single one of those institutions would take catastrophic losses simultaneously. The entire global banking system would seize up, credit markets would freeze, businesses could not borrow, payroll could not be met. It would have been a financial cardiac arrest with no defibrillator in sight. The Federal Reserve made the call. On September 16, 2008, 2 days after Lehman Brothers was allowed to fail, the government stepped in and extended AIG an $85 billion emergency credit line. It wasn't enough. Over the following months, the bailout grew to $182 billion, the largest government rescue of a private company in American history. Taxpayer money flowed through AIG and straight out the back door to its counterparties. Goldman Sachs alone received nearly $13 billion at 100 cents on the dollar. No haircut, no negotiation, full payment on bets they made with a company that was already dead. The public was furious, and rightly so, but the alternative, according to every regulator involved, was a total collapse of the financial system. Not a recession, not a downturn, a collapse. Joe Cassano was never criminally charged. He walked away with over $300 million in compensation earned during the years he ran the division. Hank Greenberg, who had been forced out of AIG in 2005 over separate accounting issues, later sued the government, arguing that the bailout terms were unfair to shareholders. He won on the legal question but was awarded zero damages. The government eventually sold off its stake in AIG and recovered roughly the full amount of the bailout plus a small profit, but that accounting ignores the trillions of dollars in wealth destroyed across the global economy, the millions of jobs lost, the homes foreclosed on, the retirements wiped out. AIG Financial Products was not a hedge fund taking wild gambles with its own money. It was a division of an insurance company using the parent's sterling credit rating to sell promises it could never keep. The models said it was safe. The regulators never looked. The rating agencies kept their AAA stamp on the door, and $500 billion in exposure sat on the books of a company that had set aside almost nothing to cover it. One division, one product, one company, and when the music stopped, the entire world had to pay the bill.